Here's what I'm watching today, and it's something that should concern anyone paying attention to how liquidity actually moves through the financial system. JPMorgan Chase just pulled off a move that looks eerily familiar to what happened right before the 2019 repo crisis. And when I say familiar, I mean they're running the exact same playbook. Let me walk you through what's happening, why it matters, and more importantly, what this could mean for markets in the months ahead. When I look at the banking data, there's a pattern emerging that most analysts are missing. JP Morgan has systematically reduced their Federal Reserve deposits by roughly $350 billion over a strategic time frame. Now, to understand why this matters, we need to step back and look at how bank reserves function in the financial system. Bank reserves are essentially the grease that keeps overnight lending markets functioning smoothly. When banks need short-term cash, they turn to the repo market. This market depends on banks having excess reserves they're willing to lend out. When those reserves get drained from the system, liquidity tends to tighten, and that's when we start seeing stress in funding markets. What's interesting here is the timing and the magnitude. This isn't a gradual drift. This appears to be a deliberate repositioning. The 2019 precedent we can't ignore. Let me take you back to September 2019 because the parallels are striking. In the months leading up to the repo crisis, JP Morgan reduced their Fed deposits by approximately $158 billion, a 57% decline through June of that year. That withdrawal represented about a third of the total reserve drain happening across the banking system at that time. Then, in September 2019, repo rates suddenly spiked to 10%. That's not a normal market move. That's a liquidity seizure. The official explanation pointed to Treasury settlement dates coinciding with corporate tax payments. But when you dig into what actually happened, JP Morgan's reserve withdrawal was sitting right there in the data, creating the conditions for that spike. Days after the crisis hit, Jamie Dimon publicly stated that the Fed did the right thing by injecting emergency liquidity. Of course, it was the right thing for the banks. It led to rate cuts and billions in banking profits from the bonds they'd strategically accumulated. Here's where this gets fascinating from a market mechanics standpoint. While JP Morgan was pulling reserves out of the system, they weren't just sitting on cash. Their Treasury holdings increased from $231 billion to $450 billion over this period. Think about the trade here. You withdraw liquidity from the Fed, which creates stress in funding markets. That stress forces the Fed's hand. They cut rates and restart quantitative easing, though they called it reserve management purchases to avoid the QE label. And what happens when the Fed cuts rates? Bond prices rise. JP Morgan effectively locked in higher yields on longer-dated treasuries, anticipating, or perhaps engineering, the exact policy response they knew would drive those bond prices higher. The math on this trade could represent billions in profit. Now let's fast forward to what we're seeing today. JP Morgan's Fed deposits have dropped from $490 billion at the end of 2023 to approximately $63 billion by the third quarter of this year. Once again, we're seeing stress signals in repo markets. Rates are starting to spike on certain days, particularly around month-end and quarter-end periods. And once again, we're seeing the same policy response developing. The Fed just cut rates for the third consecutive meeting, and they've restarted balance sheet expansion under the guise of reserve management purchases, buying Treasury bills to support bank reserves. Meanwhile, across the banking system, Treasury and agency securities held by commercial banks have increased by $662 billion over the past year. The banks are loading up on duration, betting that rates are heading lower. Let me explain how this trade works mechanically because understanding the structure helps us see where this could go next. Banks have been earning significant income from parking reserves at the Fed, especially during the period when the Fed funds rate was above 5%. But as rates come down, that income stream diminishes. So banks have an incentive to redeploy those reserves into longer-dated assets that lock in higher yields before rates fall further. Here's the strategic element. If you can create the conditions that force the Fed to cut rates faster than they otherwise would, you amplify the returns on that trade. A bank pulling reserves creates a liquidity shortage. That shortage shows up as stress in funding markets. That stress gives the Fed cover to ease policy more aggressively. It's a self-fulfilling policy response, and the banks positioned ahead of it stand to profit substantially. There's another key piece to this puzzle. The Fed has indicated they believe the banking system needs approximately $3 trillion in reserves to function smoothly. Before 2008, reserves were essentially negligible. Banks operated with minimal reserve requirements. But post-financial crisis, the Fed determined that a large reserve buffer was necessary for financial stability. When reserves approach or fall below that $3 trillion threshold, the Fed tends to react. We saw it in 2019, and we're seeing similar dynamics today. Banks that understand where that threshold sits can use it strategically, pull reserves down toward that level, and the Fed's policy response becomes predictable. When I look at the H8 data tracking commercial bank balance sheets, the Treasury accumulation is undeniable. Banks started increasing their Treasury holdings in October of last year, and they're up $662 billion since then. That's not coincidence, that's positioning. At the same time, we're seeing the Fed respond exactly as the 2019 playbook would suggest. They've cut rates 3 times. They've restarted Treasury purchases. They're managing reserves higher. The question is whether this is reactive policy or whether the Fed is being played by institutions that have figured out how to engineer the policy response they want. This dynamic has implications that extend far beyond the repo market. When the Fed cuts rates and expands the balance sheet, that liquidity tends to flow into risk assets. Equity markets typically rally on looser financial conditions. Credit spreads compress. Volatility tends to decline. But there's a flip side. If this is engineered tightening followed by engineered easing, we could be setting up for a cycle where liquidity becomes increasingly unstable. Each crisis requires a bigger policy response. Each easing cycle creates conditions for the next tightening shock. That's a fragile system, and fragile systems eventually break in unpredictable ways. The reason this playbook keeps working is that the Fed operates with imperfect information and faces political pressure to maintain financial stability. When repo markets seize up, the Fed doesn't have time to investigate whether it's organic market stress or strategic positioning by large banks. They have to act. Large institutions know this. They know the Fed's reaction function. They know where the pain points are in the system. And they know how to position ahead of the likely policy response. This isn't conspiracy. This is sophisticated market participants understanding how policy works and positioning accordingly. Several indicators can help us track how this plays out. First, watch bank reserves. If they continue declining toward $3 trillion, expect more policy easing. Second, watch repo market stress. Spikes in overnight rates signal tight liquidity conditions. Third, watch the yield curve. If the Fed is cutting and banks are buying duration, we should see curve steepening. Fourth, and perhaps most important, watch the Fed's balance sheet. If they're truly committed to quantitative tightening, reserve purchases should be temporary and limited. But if those purchases continue expanding, it signals the Fed has lost control of the normalization process. Here's what makes this situation different from ordinary market dynamics. The profit motive is enormous. If JPMorgan and other major banks have positioned correctly, they could be looking at multi-billion-dollar gains as rates fall and bond portfolios appreciate. We saw this play out in 2020 when the 10-year Treasury yield fell below 1%. Banks sitting on long-duration portfolios made extraordinary profits as the Fed slashed rates and launched massive QE. The same trade could be setting up again. Let me outline a few scenarios for how this could develop. In the first scenario, the economy remains resilient, inflation stays sticky, and the Fed holds rates higher for longer. In this case, banks positioned for rate cuts could face mark-to-market losses on their Treasury portfolios. In the second scenario, growth slows significantly, the labor market weakens, and the Fed cuts aggressively. This is the scenario banks appear to be positioning for. Treasury yields fall, bond prices rise, and the trade pays off handsomely. In the third scenario, and this is the tail risk, something breaks in the financial system due to the liquidity withdrawal. Perhaps it's commercial real estate, perhaps it's a leveraged fund, perhaps it's an international funding market. The Fed is forced into emergency mode, rates go to zero, and we get full-scale QE again. Each scenario has different implications for how to position portfolios. There's a real possibility that the Fed is being maneuvered into a policy error. If they cut rates aggressively based on repo market stress that's partially engineered, they could be easing into an economy that doesn't need it. That could reignite inflation pressures or create asset bubbles. Alternatively, if they resist cutting despite funding market stress, they risk a genuine liquidity crisis that spreads beyond repo markets into broader credit markets. Either way, the Fed's room to maneuver is being constrained by the actions of large institutions managing their balance sheets strategically. One thing that stands out to me is that this dynamic exists in a regulatory blind spot. Banks are allowed to manage their reserve levels however they see fit. There's no requirement to maintain reserves at the Fed beyond meeting their own operational needs. So when a bank decides to pull reserves and redeploy them into treasuries, that's just balance sheet management. But when the largest bank in the country does this at scale, it has systemic implications. The regulatory framework doesn't really address this kind of strategic behavior that influences Fed policy. For equity markets, the implication is that we may be in for more volatility as this plays out. If the Fed is cutting because of engineered liquidity stress rather than genuine economic weakness, the sustainability of any rally becomes questionable. For bond markets, the message seems clear. Major institutions are positioned for lower yields. That could create a self-reinforcing dynamic where the positioning itself drives yields lower. For the dollar, rate cuts typically create downward pressure. But if this is happening while other central banks are also easing, the relative move may be muted. What I take away from this is that we're operating in a financial system where the largest institutions have figured out how to influence policy through strategic balance sheet management. That creates an environment where traditional fundamental analysis may miss crucial dynamics. For investors, this suggests the importance of understanding not just economic fundamentals, but also the structural mechanics of how liquidity flows through the system and how major institutions are positioned. This content is for educational and informational purposes only. The analysis presented represents my interpretation of publicly available data and should not be considered financial advice. Market conditions can change rapidly, and past patterns don't guarantee future outcomes. Anyone making investment decisions should conduct their own research and consult with qualified professionals as appropriate.